that you defined at the point that you made the gift, and you didn't have to continue to exercise because it's built into this entity. So irrevocable trusts are very popular for purposes of transferring assets during your lifetime as well as at death, and we'll talk about that later. But irrevocable trusts can be a wonderful way to do a lot of estate planning and to avoid a lot of taxes and still address your control and management issues. Now there is this idea of a simple gift. I don't want to rule that out. It's a technique that under the right circumstances is fine. As a matter of fact, it's better than an irrevocable trust if you know that you're giving it to someone who you have confidence in, and that those circumstances are compatible with just a free and open gift. That certainly meets IRS standards. You wouldn't have an income tax problem. I have to tell you, though, that when you talk about gifts, it does mean that you're transferring your tax basis to the other. So when you make a gift of an asset, whatever your basis in that asset, let's assume that you have a piece of real estate and you paid $100,000 for it. And at the time you make the gift, it's worth $200,000. So at the time you transfer the gift, what is the value of the gift? Well, the value of the gift would be $200,000. Now that answers the gift tax question. What about the income tax question? The person who receives it takes your basis. So if your basis was $100,000, then that is their basis. So the donee, if they were to sell that a year later for, say, $250,000, they would have $150,000 capital gain, assuming they had held the real estate in that form. So the general rule then, whenever you're making a gift, is that it's going to transfer at your existing basis. Now that's very different from if you had held that until your death. One of the advantages from an income tax perspective of holding an asset until your death is that a capital asset will get a stepped up basis. That's huge. If you have someone, let's say someone who's later in life, say they're 80, 85 years old, and they're trying to make some of these decisions, and they have real estate that they've held for many years, and perhaps there's a basis in that real estate of $100,000 and it's worth $10 million today, and there are those circumstances. That would be a huge mistake usually to make a transfer to someone, a gift to someone else at that stage, where you're not going to get that stepped up basis that's going to occur at the date of death. If that person hangs on to that and 2, 3, 4 years later they die, then the tax basis of that asset is $10 million. It means that if it's sold thereafter, that there would be no income tax due on that, again, to the donees or to the beneficiaries. I mean, that is huge. Now again, it's a separate issue about the estate tax question. And sometimes, you're at a fork in the road where on the one hand you're weighing, gee, if I hang on to this asset as I'm inclined to do for income tax purposes, it means I'm going to get hit for the taxes on the estate. And you have to weigh those tax rates, and you have to do some math, even consider the rates of your beneficiaries too, to decide at the end of the day what is the best way to go. But one thing to keep in mind from an income tax perspective is that difference between transfers that are made by gift versus those that go through the estate. Another form of transfer would be one in which you sell an asset. Now we've talked about gifting to an irrevocable trust. We've talked about outright gifting. And now I want to introduce you to an idea that you can actually sell assets. You can do what would be considered a bona fide transaction, arm's length, fair market value, in which you get an asset out of your estate, and at the same time you reduce what's going to be in your estate. That's the sort of opportunity for creativity that you have when you're deciding how to do your estate planning. It's interesting. Estate planning really is one of the areas of the law where there's just a wonderful opportunity for creative thinking on the part of you and the team around you. It's not unusual to have several professionals participate perhaps in these round table or other discussions, depending on the size of the estate. But there's lots of room for creativity, and there's even disagreement among skilled professionals in this area, and particularly on these issues that we're talking about now. For example, some would encourage a gift, maybe an outright gift. Some would say, no, my suggestion is that we have it in an irrevocable trust. Usually the client is in a position to call a question like that. Once they're fully informed of the implications of that decision, usually a client can pull that trigger better than anyone else. But it's on the issues that impact on the consequences of these transfers that you really have to rely on your professionals. But sometimes, though, it's better to do a sale or a transfer in which there's some compensation so that it's not considered a gift in order to avoid estate tax consequences. Now, the way that you do a sale, it could still involve a trust. As a matter of fact, many sales are to irrevocable trusts. That way you kind of have your cake and eat it too. You're doing a transfer out of your estate, but it's not one in which it's subject to a gift tax because there is no gift, it's a sale. And yet you're maintaining this control, but you're not violating those rules we discussed earlier. It's not really like that situation where the parent makes a transfer, a gratuitous in that case, a gift to a irrevocable trust and continues to exercise the sort of dominion and control as they would if they had it in their name still. That is a problem from the IRS standpoint. But it's a little different when you create this irrevocable trust, as we described earlier, where you just put in rules that you can live with. You put in trustees that you trust, but yet are independent of you. So you kind of have your cake and eat it too when you do these types of transfers. Now, if you're doing a sale, you've probably just come to your mind already, but wait, if I'm selling an asset as part of my estate planning rather than gifting, aren't I simply transferring one asset for another? If someone gives me fair market value for something, then now I have that in my name. And when I die, that's going to be in my estate and that's going to be taxed. But it may still make sense, though. You have to come back to that point we were talking about a while ago when we talk about leverage. That means selecting what is the best asset to transfer. And again, that's the art more than the science of estate planning too, is to identify those assets that you want to transfer out of your estate and those that you want to keep. And when I mentioned a while ago which is most likely to appreciate, sometimes it's not so obvious. There are those examples that I gave in which you do have every reason in the world to believe that assets are going to take a certain direction in terms of appreciation. But there are some assets that you simply can't predict. And so you have to decide, do I have in my estate things that lend themselves to these sorts of lifetime transfers, and should it be a gift or should it be a sale? Now, you talk about sales, this discussion can get very complicated very fast. The IRS will respect certain types of transfers if they're in certain forms, but they will dictate those forms if they're transfers to family members or other insiders. And let me tell you what I mean by that. The IRS is very distrustful of transfers to family members for the most part, gifts, or even sales. So transfers made to family members are going to be subject to special rules, the way that they're valued. It's not uncommon when someone is doing a sale or a gift for them to try to retain some part of that asset. And if that's not done correctly, then the IRS will assume that the part that's retained by that person is really zero. Now, that in some respects you may think, well, fine, that means that it's a completed gift. But the whole idea was to minimize the potential gift tax liability and at the same time have them use up what they kept in their name before their death, which means they pay very little gift tax, if perhaps no gift tax, and they have no estate tax because they just kept a portion of the asset that would expire or they could use up prior to their death. So that technique the IRS spotted very early. And so they decided, look, when you have transfers to certain family members, gratuitous transfers, then you have to comply with these rules or we're going to impute that the transfer is made entirely to that person, which would, of course, be treated as a completed gift at that moment. There are a lot of complexities here that I don't want to get sidetracked on, and as a lawyer it's tempting to continually introduce these qualifications or these limitations to what I say, and my determination here is to stay on the broad main road, and then it's for you to discuss with your estate planner some of the details and the complexities of these ideas. I think I want to stop here. We've covered kind of a lot of territory today. Maybe we've covered too much territory today. But when we come back, I want to discuss this issue of, gee, how do I do a transfer during my lifetime in a way that I'm going to minimize my tax liability, hopefully. Should I consider a sale? Should I consider a gift? Should I consider a partial sale gift? And then I also will, if I have time in the next show, I'll talk a little more about this marital deduction planning. And this can be very exciting. The reason it can be is that if done correctly, you can avoid taxes entirely, even if you have a relatively large estate. But you have to take care of these relatively simple things. And as a lawyer, I have to tell you, it's very frustrating when I see people